To avoid 30 to 40% in labor liabilities, dishonest contractors have long relied on a simple mechanism, paying their workforce in off-the-books cash. Historically, discovering this fraud required physical, retroactive events. Investigators couldn't see the crime happening. They had to wait for the consequences to surface on the job site. Often, the first sign of a scheme is an accident. An undocumented worker arrives at an emergency room and provides their employer's information during intake. When the hospital attempts to verify coverage, the process hits a dead end. The state board searches official records and finds no trace of the injured person on the company's payroll. This creates a disconnect between the visible headcount on a commercial roof and the contractor's official tax filings, which may only claim a handful of clerical staff. A second trigger comes from the market itself. A legitimate contractor loses a bid by a margin that is mathematically impossible if the winner were paying mandatory taxes and premiums. The problem with these physical triggers is the lag time. By the time a state agency initiates an audit based on a tip or an injury, the illicit cash has already moved through the underground economy. Relying on these physical world events is too slow and fragmented to dismantle multi-million-dollar evasion schemes. On June 5, 2026, the Financial Crimes Enforcement Network, or FinCEN, issued Advisory FIN 2026-A002 to close this enforcement gap. This directive moves the responsibility of detection off the construction site and places it squarely onto financial institutions. Instead of waiting for physical accidents, banks are now expected to use automated transaction monitoring to recognize the digital patterns of off-the-books payroll operations. The objective is to identify business-to-business cash evasion schemes exactly when the funds are being extracted from the banking system. FinCEN has effectively deputized the banking sector, making financial institutions the frontline investigators of underground payroll networks. Every large-scale evasion scheme shares the same structural hurdle, converting traceable digital capital into untraceable physical cash. To do this, fraudsters inject an intermediary into the supply chain, the labor broker. The sequence starts when a primary contractor sends a large payment to this broker for subcontracted services. This broker is usually a shell company acting illegally as an unregistered money services business. It has no real employees and no physical office presence. On the primary contractor's ledger, this payment is recorded as a subcontract labor expense. This label hides the money from the categories that would normally trigger payroll tax or insurance obligations. The shell company then negotiates the check at a bank or check casher, immediately extracting the funds as physical currency to pay workers off the books. By paying the final workforce in cash, the network bypasses federal payroll taxes, state unemployment insurance, and workers' compensation premiums. Stripping those liabilities allows dishonest companies to maintain two sets of books, keeping their labor costs 30 to 40% lower than their law-abiding competitors. The shell company's role in this architecture isn't staffing. It is a laundering mechanism designed to generate the cash needed to eliminate labor costs. To break this loop, FinCEN's June 2026 advisory established 18 transaction patterns that banks must now actively monitor. These patterns are coded into automated banking software to detect the specific mechanics of large-scale cash extraction. The first pattern focuses on rapid depletion. An account receives a large business-to-business infusion, like $250,000, and immediately executes a cash withdrawal of nearly the same amount. A legitimate construction firm or staffing agency does not operate this way. They maintain stable cash reserves to cover materials and overhead rather than exhausting the account every week. Banks also look for a cascade of repetitive checks issued for amounts like $850 or $900. These are often sized to stay just below common reporting thresholds. Software also flags ghost shells, newly formed LLCs that receive millions in revenue from major contractors, despite having no history of payroll tax payments. Identity documents provide another data point. Systems alert when a commercial construction account is opened using an individual taxpayer identification number or a foreign passport, followed immediately by heavy cash conversions. While using an ITIN is entirely legal, FinCEN mandates that when this document type is paired with rapid cash extraction, the bank must conduct enhanced due diligence. When these patterns appear, the bank files a suspicious activity report using the specific financial integrity tracking code provided by the advisory. These monitoring requirements make the act of generating physical cash visible to regulators in near real time. Even with precise monitoring, anti-money laundering efforts historically struggled with institutional data blindness. In a fragmented system, Bank A sees a contractor paying a staffing agency, while Bank B only sees that staffing agency withdrawing cash. No single institution sees the complete loop. Strict institutional privacy laws previously prevented these two banks from communicating, meaning the suspicious connection between the payment and the withdrawal remained hidden. On June 12, 2026, FinCEN expanded the safe harbor rules under Section 314B of the Patriot Act to solve this. This update allows banks to voluntarily and instantly share intelligence regarding suspected payroll and check fraud with one another. Institutions can now collaborate without fear of liability, sharing data points to see if their separate transactions are part of the same evasion network. When Bank A and Bank B cross-reference their data, they can correlate the outgoing payment with the physical withdrawal, exposing the fraud network before a government subpoena is ever issued. This collaboration enables isolated anomalies to be mapped into a larger network, providing federal task forces with a complete picture of the illicit flow. This banking intelligence feeds into a larger grid of state and federal enforcement agencies, where departments of labor and tax divisions run automated sweeps, matching these banking reports against a company's historical filings. Workers' compensation rating boards use this financial data to cross-reference reported payroll against active job site headcounts, triggering immediate premium fraud audits. Simultaneously, the IRS Whistleblower Office leverages these exact paper trails, offering significant financial incentives to individuals who report tax evasion. For the insurance sector, this underscores the importance of cross-source intelligence platforms like Loki. These platforms synthesize isolated variables, financial flows, claims data, and corporate shell structures into a single risk profile. Correlating transaction data with operational reality allows carriers and TPAs to identify premium leakage and misclassification long before an injury occurs. The advantage of hiding in the physical world is diminishing. As multi-agency data matching becomes the primary tool for enforcement, the gap between the job site and the ledger is narrowing.